On the 30th of October, Starbucks presented their earnings report, where they missed on EPS and revenue, and the stock didn't move as a result. Looking at the year-to-date chart, we see that there was a big drop with the previous earnings report, but also a big increase a few months later. For the upcoming earnings, all analysts expect another miss. So, is Starbucks in a dangerous position right now, or are they going to surprise us all? Let's find out more about Starbucks stock in today's video. Diving into the earnings, we see that revenue was reported at 9.1 billion, down 3% year over year, which is a bit of a rough start. North America represents about 74% of the total revenue. International is sitting at 21%, and channel development is at 5%. And one of the more important numbers for Starbucks is the comparable sales, which is currently sitting at minus 7%. And especially China is not looking good at all, with minus 14%. Operating margin was reported at 14.4%, down 370 bps year over year. Also not looking great, to be honest. EPS also decreased 24% year over year. So again, not looking any good here. And keep in mind that the global store count was increasing at 6% year over year. So with more stores, there was less revenue. That's why comparable sales is really important. Diving a bit more into detail here, we see that North America, representing 74% of the total revenue, is down 6% in comparable sales. And especially the margin took a really big hit here. Looking at the international segment, representing 21% of the revenue, we see that comparable sales is also down a lot, with 9%. Margins took a hit as well, but not as much as we saw earlier with the North America segment. The first segment, representing 5%, is down in revenue, but managed to see a higher margin, which is the silver lining here. Next up are the fundamentals of this company. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Starbucks stock is a 112 billion market cap company. PE ratio is at 29, indicating they could trading at a massive premium. Later in this video, I will show you my 3 price targets for Starbucks stock, so make sure to watch until the end. Revenue is at 36 billion, and in this graph we see that revenue went up at a pretty steady and consistent pace. Of course, we see the impact during the lockdown periods. The recent quarter, Starbucks is really struggling with their revenue. Margins are going up in the long run, and this is really important to me. However, it is not really steady and consistent. And after the recent earnings, we see that margins took a big hit as well. EPS is looking pretty good. In the long run, it is going up. The only thing is that I prefer a bit more steady and pattern here as well. Analysis expect that EPS will increase at a really high pace in the coming years. So this is actually looking promising to me. For the revenue, analysis expect also pretty high numbers. On average, you're looking at 8% growth per year, and it is expected to reach 52 billion in 2028. Return on assets is sitting at 12.5%, which is a great number. Return on equity looks really bad, but the most important number, return on invested capital, is sitting at 45%, which is a really great number. It is slightly lower versus the 5-year average, but nothing that concerns me a lot here. Current ratio is at 0.76, which is a decent number. Nothing really special to mention here. And right now Starbucks has 25.8 billion in debt. And I prefer companies that can pay down at least a big chunk of the total debt with the total cash. Starbucks has 3.5 billion in total cash, so they can't pay down a big chunk of their debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, and all other things. And here we see that free cash flow is going up in the long run. However, it is again not really steady and consistent. We also see the impact during the lockdown periods. Shares outstanding are decreasing, which is something that I really like. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2.5%, which is a great number. Annual payout is at $2.44 and payout ratio is around 70%. I prefer 50% or lower, so right now they have 30% left in cash to buy back shares, pay down debt, do acquisitions, and all other things. The 5-year growth rate is at almost 10%, which is a great number. On top of that, they increased the dividends for 14 years in a row. And if you take a look at these numbers, the dividends paid since 2014, you see that Starbucks did increase the dividends at a really high pace. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that payout ratio was always a bit on the higher side. I would prefer 50% or lower, but I'm okay with the current situation. In this graph we see the expected dividends in 2025, 2026 and 2027. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at a higher rate versus previous years. And overall, these dividends look really good to me. But how about the historical returns? I decided to compare StarBucks stock with the overall market. In this case, the S&P 500. On the 5-year chart, we see that Starbucks underperformed the S&P 500 big time, with only 31% return. And this is including dividends. The S&P 500 returned 105%. On the 1-year chart, things look pretty interesting, with Starbucks sitting at minus 3%, while the S&P 500 is sitting at a 32% return. On the 6-month chart, it is the other way around, and this time Starbucks is sitting at 28% return, massively outperforming the S&P 500. On the 1-month chart, it is a tie with both returning 1%. So bottom line, Starbucks was beaten in the long run, and in the short run it seemed like the company was finding some momentum. But the recent earnings didn't really push the stock in the right direction. So could this be the perfect time to buy Starbucks stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 4, 6 and 8%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 12, 13 and 14%. For the free cash flow margin I'm putting in the same numbers. For the PE ratio I'm putting in 20, 22.5 and 25. For the price to free cash flow I'm putting in the same numbers again. In my opinion, Starbucks has a big moat, so I'm willing to pay a premium for that. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, Starbucks stock is around $98. I hit analyze, and we see a lot of red numbers. We have a low price target of $58. We have a mid price target of $79. And we have a high price target of $107. And to me, the mid to high price target is the most justified here, indicating that this stock is a bit on the higher side of this range. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Starbucks is that I love the company, and most part of the business as well. But there is no denying that the company is facing some tough times. Revenue isn't growing yet, and margins are under pressure as well. And there are multiple reasons why this is happening, such as economics, but also more competitors. For now, I'm waiting before I pull the trigger on StarBucks. I was lucky enough to buy more shares when it dipped around $70. And as of right now, StarBucks is my biggest position. I expect that the company will recover in the coming years, but this will take time, of course. I will keep analyzing this company from time to time. But for now, I'm holding this stock. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.